Welcome to The Explainer. So, today we're going to dig into the financial story of EG Industries. And it's a really interesting one because there's this puzzle right at the heart of it. It all kicks off with just one number. So, what is this? 22.6? This is the company's price to earnings ratio. And what that tells you is how much investors are willing to pay for every single dollar the company earns. For a manufacturer, let me just say, that number is really high. And that's the big mystery we're going to solve today, isn't it? The market is pricing this company like it's the next big thing out of Silicon Valley, not a nuts and bolts manufacturer. There's this growth premium baked in, all because of their promised expansion into 5G and AI. But the real question is it actually justified? To figure that out, we have to look past the shiny, glossy brochure they hand out and, get our hands a little dirty. We've got to pop the hood and look at the financial engine room, because that's where the real story is. Okay, so this reveals a real split personality. On one hand, you've got this amazing growth story that investors are clearly in love with. High PE, it's profitable, it's got this incredible high-tech future. But on the other side, you have what I'm calling the grinder reality, and that's razor-thin margins and a seriously tight cash situation. Let's really zero in on that gross margin, okay? It's just 12.4%. That is way below the industry benchmark, which sits around 18%. In this business, that's what we call the danger zone. It just leaves the company incredibly vulnerable. And here's what that means in plain English. For every $100 of product they sell, nearly $88 is immediately gone. Poof, eaten up by materials and labor. Any little spike in raw material costs could just make that tiny sliver of profit completely vanish. So, how does this actually affect their day-to-day? Well, that brings us to our next key metric, the current ratio, and it is only 1.15. This is probably the best way to think about it. The company is profitable, right? That's like someone with a pretty good job. But with a current ratio this low, it means they have just enough cash coming in to cover their bills and almost nothing left over. There is absolutely zero wiggle room if something unexpected happens. Now, this raises a huge question. If the company is profitable, a 7.1% net margin isn't bad. Why on earth is their cash situation so tight? Well, the answer is kind of buried deep in the balance sheet. This is the million-dollar question for any investor, right? You want to know the real health of a company. Profit on paper is one thing, but actual cash in the bank, that's what keeps the lights on. So where is it? This number right here, the quick ratio, this is the smoking gun. At 0.37, it tells us a very specific and honestly a very urgent story about where the company's money really is. The key phrase here, the most important part, is without having to sell its inventory. See, the current ratio we looked at earlier includes all that stuff sitting in the warehouse. The quick ratio strips it all away to give us a much harsher and frankly a truer picture of the cash they have ready to go. And this reveals the company's biggest problem. Their cash isn't really cash at all. It's trapped. It's sitting on warehouse shelves in the form of raw materials and finished goods, and it's acting like this giant anchor, just weighing down their financial flexibility. But look, management isn't just sitting around watching this happen. They have a really high-stakes plan to pull up that anchor. But it is a genuine race against time. So this three-step plan, this isn't just about playing with cool new tech. This is a survival strategy, plain and simple. The whole point of moving into 5G and high-tech manufacturing is to make products with higher margins. Better margins would fix that core profitability problem. And this is crucial. It would finally unlock all that cash that's trapped as inventory. So, after we've looked at the glossy brochure, the gritty engine room, and this high-stakes survival plan, what's the final verdict for you, the investor? Here's the bottom line. The company is making money, but it is stretched incredibly thin. That high stock price you're seeing is all about a bet on the future. It is not a reflection of today's financial reality. Everything, and I mean everything, depends on their ability to pull off this high-tech transition without a single misstep. And ultimately, this says it all. If you invest in EG Industries today, you're not just buying a company, you're buying a plan. You are paying a premium for the belief that this management team can navigate these really treacherous waters, solve their cash crunch, and turn that high-tech dream into a financial reality. So the final question is, do you believe they can pull it off?